The views expressed on this podcast are those of the participants, not of Reuters News.
I mean, the sort of the snack back and then, oh, you were a terrible company, now you're a great company. I mean, it's sort of, you could ignore that as a CEO, right? But just, they don't like to do that. It's incredibly, your job is to go around and talk to shareholders constantly. And I think what a CEO that's hating being a public market CEO would say in response to that is, it's incredibly time consuming, and to an extent you can't ignore the market's view of what you're doing.
Double-digit collapses, shares soaring on very little information. This is the state of the stock market in Europe and the US during the most recent earnings season. To name check a few of these companies, British fashion label Burberry stock soared 17%, while US payment business Fiserv tanked 19%. Toy maker Hasbro, French train maker Alstom, and software group ServiceNow have also swung between dramatic climbs and worrying falls. For CEOs that are running these companies, a sense of whiplash is not the only concern. Amid trade wars and real-life wars in the Middle East and Europe, the future is painfully uncertain, but chaotic swings in their company's shares will also have an impact on their ability to raise equity. In a broader sense, it's also likely to damage the appeal of the public market. But what are the forces driving these moves? And is there anything companies can do to mitigate the fallout when they shift their growth forecasts? The answers to these questions and more are the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with Breakingviews columnists. And I'm your host, Amy Donlan.
And I'm Jonathan Guilford. Amy, it feels like this earnings season has been a lot more dramatic than most. I hesitate to say it almost, but it kind of feels a little bit like 2008 or the pandemic again, where companies were really struggling to communicate what the future would look like. Jittery investors were pouncing on any bit of bad or good news and running with it. What's it been like in Europe?
Yeah, it's very, very similar. I mean, we've kind of been scratching our heads sometimes when we were just looking at what was happening to companies' shares, and we'd be like, oh, that doesn't seem like a huge shift in guidance, or, something major happens, and it does seem like the investors are running very, very fast with the decisions that they're making. And I did speak to a few of the executives of these companies that have seen the shifts off the record. And they are also trying very carefully to word press releases in a way that, doesn't focus too much on the negative, tries to get the sort of nuance of the picture across. But they are spending a lot of time thinking about how investors are responding. And thankfully, we have Liam Proud here. So Liam and I worked together on a big view, which is one of the big features for Breakingviews, really about this topic, just kind of looking at all of the big shifts and what were some of the moves that we were seeing, what were some of the reasons we were seeing these big moves. So Liam, you're very, very welcome.
Great to be here.
All right, Amy, since you co-byline that feature, you're going to play both host and guest today. You've been taking, as you said, a look at these big swings in the stock market. Is there sort of a general trend here? Because I know there's been research from the likes of Bank of America and others kind of looking at companies that held guidance or ditched guidance, or kind of what the effect of that was through various cycles. This time around, you said you're talking to executives of some of these companies. What are they saying?
So they're saying, obviously, that the future is very opaque for them. And they're saying that when it comes to tariffs, that they don't really know how to address what's coming. And so they are saying that they think, even historically, even factoring in a lot of kind of big things that have happened, the invasion of Ukraine, pandemic, that this does seem like they are seeing bigger shifts that they can't really explain with the guidance that they are putting out, or the small changes that they are making, they think, to their guidance.
Right. And I kind of wondered how much that stuff layers on top of each other, right? Because we have, to be clear for listeners, we have the trade war sitting in the background there, which is everybody is on a kind of hair trigger about, oh, are you going to be able to deal with whatever the latest tariff is? Or more than that, the sort of, the steps down the chain of, are you going to be able to deal with it when that tariff goes back to 10% and then back to 60% and then back to 20%? you also have all of the AI narratives and the big sensitivity to what's going on in tech and so on that's happening with a lot of companies as well. I mean, Liam, when we're thinking about the forces at play here, like, is it just that we're getting a stack of all these different kind of like narrative cycles that are meeting? Like, what's going on here?
I think it's a good question, Jonathan. I think it's kind of important to put these two explanations in kind of these types of explanations in two big buckets, really, which I think is kind of what Amy did with the piece that she wrote on this. Was there is obviously a lot going on in the world right now, which is, you don't need me to tell you that. So I think a lot of what we're talking about here, when we're talking about the big stock swings after announcements of earnings, is just there is actual dramatic news going on. And then separately, there's a whole set of explanations that relate to sort of kind of arcane sounding things, but are actually really interesting and important and potentially seismic around market structure and who's selling and who's buying and the speed of that. So on the first bucket, I think Amy dug out some numbers. There's this thing that kind of Wall Street watchers like to follow called the earnings revision ratio, which is an incredibly nerdy sounding thing, but it's very simple. It's just like, to what extent are analysts upgrading their forecasts versus downgrading them after each earnings season? After hearing from companies, does the street get more or less bullish about the companies it's following? And that's been I think close to record lows in the United States and kind of close to March 2020 lows, which is obviously around the pandemic in Europe. So that kind of testifies to the fact that, for the reasons that you outlined, Jonathan, CEOs and CFOs and therefore analysts are kind of struggling to get a hold of what's going on and what their business is going to look like. So therefore, it would stand to reason that investors would kind of freak out every now and then and say, "Oh my God, I didn't realize it was this bad," or "Oh wow, I didn't realize it was this good," and the stocks could go all over the place. But I think there's a second bucket that you need to think about as well, which it comes out more in the anecdotal side of the reporting. And it's essentially the collision of these big forces that have happened in stock market investing in recent decades. I mean, one of the big ones is the rise of passive investing, which, in case anyone doesn't know, is essentially this style of putting money into the stock market where you put it in an index fund, which essentially buys everything, and it doesn't really have any discretion over what it buys. And the effect of that is that there's a few big kind of asset managers that essentially own everything and don't trade it. And the flip side of that is that there's a kind of all the trading that happens, probably a smaller percentage of it is being done by people who are actively taking views on individual stocks. And then sort of to drill down in that thing a little bit further, the people who are actively taking views on those stocks are arguably doing so on a more kind of flighty basis than in the past. So the kind of bogeyman out there that people like to talk about is, pod shops and quants and all these kind of things. I think you have to be wary of those phrases because CEOs say them because it makes it sound like we're not the problem. It's all these, short-termists in the market and stuff. And the short-termists in the market are always there. And that doesn't explain, Mr. or Mrs. CEO, why your stock is down 20% today, but it is relevant when looking at the totality of these moves, right? So pod shops would be a kind of a very big hedge fund with a lot of different investors who are generally taking views on whether or not earnings are going to be better or worse than the market has factored in. That's a very common activity for those people, so it stands to reason again that people would cash in and out of those bets immediately. And there's a correspondingly smaller number of people, I think, who are sitting around doing work on a stock, running a fund with a 10 or 20 year horizon and saying, oh, I'll scoop up a bit of that and, I like it. The price has gone down 10%. So again, it's really hard to kind of play, judge between these different explanations. I think there's probably a bit of everything going on, but it's certainly kind of showing up in the moves anyway.
The eternal refrain of somebody trying to figure out what is going on in this market. I hear there's a pod blowing up.
Yes,
Amy,
exactly.
Is there anything that you would add to that? Because obviously there's, there's retail as well. There's, kind of changing communication strategies from bosses. Like, is there any kind of like further complication to those dynamics?
There is, because I think one thing that I think is really interesting about this situation from the side of the executives, exactly as Liam said, who do very quickly point to these types of investors that are just, they've got their algorithms, they're basically reading these press statements like it's a computer that's reading it, that they don't really, they're just seeing revised, earnings guidance to X, sales guidance, sell. And that's why it's happening so quickly. But I think, again, from when you speak to executives, what they're saying is that the difficulty with that is that you will see a huge sell-off. So let's say like a 17% sell-off in a stock. And then what will happen is that after results, executives go around and they speak to all their investors, and the investors that they, some of these index funds that would hold their stock, they're having to answer to why the stock is falling so much and what is the future really like, and these big existential questions that then these executives have to spend a long time reassuring investors that actually the business is okay, that it's healthy, that this move is kind of inexplicable. And then in many cases that we saw kind of writing this piece, the shares did recover, over the next few weeks. But I think, though, the sort of bigger picture of this is we have a kind of desert of an IPO market at the moment because a lot of companies don't want to brave the stock market, given what's going on with tariffs and so much uncertainty. It is very, very difficult to kind of make the case that you should enter the market in this way. But I think this kind of compounds that, because if you are out in the market, is that your stock is swinging so wildly all over the place. And then if things get quite bad, if there's a recession in the US, if some companies need to raise equity, that this could actually make it more expensive for them, because investors are looking at these forces thinking that it's not a stable stock price. And I think that is sort of one of the problems that we kind of uncovered, that we think is sort of the issue that this also creates. And I guess it also means as well, if you are a private equity buyer looking to the stock market and thinking about companies you want to buy, maybe that argument that you make for going private is easier to make, given what's going on.
I just wanted to pick up on a point that Amy kind of raised there, which I think is really important, is, I mean, so we I think we were quite aware of this idea of, well, you just anecdotally picking big numbers and stringing together a narrative. So we were quite keen to sort of try and find an example where it did seem clear that the market had overreacted and then sort of come back. And we sort of went through the data and we found this day, I think it was April the 24th in the US earnings season. There was one day where you had, I think it was ServiceNow, the software giant, and Hasbro, the toy maker, were both up roughly 15% after earnings, and Fiserv, the payments processor, was down. I think it was almost 19%. And I think the number that Amy put in the piece was, if you then took it from the low in Fiserv's case, or the high in ServiceNow and Hasbro's case, and then said what happened over the next 5 trading sessions. Well, the one that had fallen then outperformed the S&P, and the ones that had gone up then underperformed the S&P. So you have, like, again, this is not systematic kind of evidence, but it's sort of, it plays into the anecdotal sense that's definitely out there, that there are overreactions and underreactions going on. Now, I'm fully aware of what a efficient markets hypothesis kind of, guru would say to that. This is someone who believes that markets are always and everywhere extremely factoring in information efficiently and processing it and turning it into prices, and the market's always right. They would say, okay, you think you're so smart, why don't you start a kind of contrarian hedge fund? If you think there's loads of alpha in the market for buying and selling in the opposite way to what the market does on day one, then that should be arbitraged out. Then that should immediately, by virtue of that existing, it should be traded out of existence. So there's a kind of, circular element to this argument here. But I think, it's strong enough, and you hear it from enough different corners and kind of feel it when you cover these companies, that, I think it's worth dwelling on, particularly given all the kind of, background forces that we've been talking about here.
Right. And I guess, if part of the explanation for why this is happening is that structural change in liquidity effectively in the actively traded part of the market, as we enter an environment where we do have all of these larger macro narratives that are pushing for everybody's attention, and the swings off of those are going to be very large. As Amy said, we have been in a drought for IPOs for a long time. The reason for that drought has changed since the beginning to where we are now. We nonetheless have a bunch of people lining up. Given that you're seeing a lot of snapback and kind of mean reversion after these big moves, obviously the way the market is right now doesn't feel like an advertisement for doing an IPO. But is there sort of an argument behind that, saying like, just do it? Like, we've got, Chime, Circle, all these other folks lining up. We had obviously CATL's huge listing over in another venue. Does it make sense to just say, let's just look through this and go for it and take the leap?
I think I can see that argument. I mean, the sort of the snack back and then, oh, you were a terrible company. Now you're a great company. I mean, it's sort of, you could ignore that as a CEO, right? But just, they don't like to do that. It's incredibly, your job is to go around and talk to shareholders constantly. And I think what a CEO that's hating being a public market CEO would say in response to that is, it's incredibly time consuming, and to an extent you can't ignore the market's view of what you're doing. If the market's view is that you've completely missed your guidance here, and your strategy as you had communicated it is now not going to work, and that's evident in the forward forecast from analysts, and it's evident in the valuation, you can't just ignore that indefinitely, right? You have to respond to those price signals at some point. Whereas, if you're owned by, a Blackstone or a KKR, you're a kind of private company, you don't have that input, really. It's not the same. So I can see it happening on the margin. I mean, obviously there's, it's not like buyout firms are going to own everything. That would be ridiculous. But I think it's a marginal disincentive to be public. And if you look at the companies that are on the margin, because, there are companies that are always going to need to list to be public. But if you look at companies that don't need to, but could, I'm thinking about Stripe, SpaceX, Databricks. They're not doing it. And if you say to them, you don't need cash, you don't need liquidity. You've been able to get liquidity on your stock through these big secondary rounds, through selling shares to other investors. And by the way, you're not getting this constant cycle of the market hating you and then loving you, and you having to respond to that rather than doing what you think is the right thing by the business. It's sort of it's hard to make that case you were making, I think, Jonathan, in those specific cases.
I think as well, I would just sort of add to that as well, is like, if you are a company thinking about IPOing, where you are in your lifespan, right, is that you're growing and you want to do lots of kind of creative things. And again, like to Liam's point, if you are spending a long time discussing why your share price is moving back and forth with investors, that's right. I think it takes away from your ability to do the things you want to do, the more dramatic things you want to do. And I think, you're right. If you don't need to do that, I think this would be certainly an advertisement for not doing it. But I think for the companies that are already out in the market, that are already in the public market, we can already see things that they are doing to sort of mitigate this a little bit. And one of the things is, and this drives me kind of crazy when I'm covering a company and they release guidance that is so vague that there's quite a gap between what they are saying they can achieve. So I'll give an example: mid to high single digit growth, which could be, anything, basically from 5 to 10. And they don't say 5 to 10 because obviously that's a huge range. So I think that's what we're going to see more of. We're going to see companies just sort of trying to write, as I said, these kind of press statements and try to put their guidance out in a way that, first of all, they're more likely to achieve what they say they're going to do, and there's less of a knee-jerk reaction to them changing the guidance because it doesn't seem as stark as what they're actually saying.
So more caution ahead makes sense as a takeaway after everything that we've seen from the past few months. I think that is a totally reasonable place to wrap it up. Amy, Liam, thank you so much for walking us through this.
Thanks so much. It's great.
Thanks, Jonathan.